Good morning and welcome to MarketCast IV. Okay, a really brief word about the shirt because we've got an awful lot to get through this morning. I didn't actually put this one out to a viewer poll. I just selected it. It was the choice between this and a sort of bubblegum and butterfly thing, and I felt that this was probably more appropriate. Welcome from the AF Oliver offices here in Bournemouth, and as all the people here start to arrive for a day's work, I am going to try and take you through the current situation in the UK residential property market. It's a crazy thing, isn't it? Here we are, we're still in a position where put a decent house on the market and it's sold sometimes in hours, but certainly in days rather than months. For the developers, if you've got stock out there, well, the likelihood is it's probably priced just a bit too high. We all know that the market is still running really hot. Knight Frank weighed in yesterday with a press release saying that they've revised their end of the year forecast from 5% inflation over the 12 months up to 8% inflation because they believe that the supply demand imbalance is actually going to underpin this market and see a gentle fall. But for me, I'm seeing a period of transition. I'm absolutely certain that we have passed the peak rate of inflation and we are now coming down the other side. And what I really want to try and set out to do over the next 30 minutes this morning is explore just how far we are going to move down the other side and how fast that's going to be, because that is actually going to affect some key decisions that we're going to make. I'll kick off in the normal way, but I've got to say, when it comes to the reasons to be cheerful slide, after having taken out one or two of the ones that were in there last month, I was struggling for a bit of content. We'll maybe come back to some things that we can actually think about to cheer us up a little later. But basically, Rightmove have hit another record. But Rightmove, along with Zoopla, along with the Nationwide, along with the Halifax, and anyone else you want to comment on the market, all say, here we are, new record price, but the market will ease as we go through the year. We all know it, don't we? We all know it. We're into what I call that CD time in market transition. For the developers out there, that's cancellations and down valuations. Keep a count on those in the business and see how they're moving. And this is me being on the cheerful page, by the way. Demand is still robust. Supply is still limited. No question about that. The strong labour market is still really hot and it actually shows no signs of slowing. So there are all the reasons to be cheerful. This list is starting to grow a little, as you can see. The war in Ukraine shows no sign of ending. The CPIH, the inflation rate that includes owner-occupiers' housing costs, has risen to 7.9%. That's a 30-year high. If it was just the CPI, that's 9.1%, a 40-year high. Energy and fuel costs continue to soar. The consumer confidence numbers just look awful. And we've hit new record lows since the formation of this measure in 1974. Interest rates are climbing ever upwards. Base rates now, as I'm sure you know, have hit 1.25%. And obviously mortgage rates are following. Lots of people out there, interestingly, at the moment are remortgaging to try and take advantage of lower fixed rates while they can. The Nationwide index has come off the top and its monthly number has fallen for a second consecutive month. And of course, don't forget, we're due the new Nationwide numbers out at the end of this week. And I've deliberately put this in capitals at the end of this particular slide. We have passed the peak rate of inflation in this current cycle. Of that, I'm absolutely certain. Okay, I have taken lots of charts out of this deck. I want to try and, rather than spend loads and loads of time on information that you could just get yourself by taking a look online, I want to try and provide some of that as a backdrop to what I'm going to do and what we're going to talk about. But I want to put up a really interesting concept to you today about the way that we can calculate how prices are going to move, the severity of any falls or rises, come to that, and over what period of time that's actually going to happen. We'll come to that a little bit later in this presentation. Let's kick off, unusually, with the Rightmove House Price Index. I've grouped the house price indices in this deck in asking prices first. So here we are. This is Rightmove. We'll then go on to mortgage approvals. So we'll look at the Halifax and the Nationwide. And then we'll go on to the Zoopla numbers, which is this lovely, unique a balance that they've got of asking prices, mortgages approved, and actually achieved prices, which I think is a really worthwhile index, and I think is very, very close to where the actuality lies. Here we go. This is Rightmove. Then it's another record. Look, 368,000. They break the records over and over and again. That annual price growth, though, has dipped down into single figures, 9.7%. Notice that. But look at this. So the buyer demand per property is double what it was pre-pandemic. That's what's underpinning what's going on. We'll see that as we go through some of this data. But here's a really important stat. So the June asking price, according to Rightmove, and bear in mind, I thought it was worth actually sticking this rondelle in here. These numbers are based on over 100,000 asking prices. That's around 95% of all the properties on the market in the UK at the moment. So they're pretty robust numbers as asking prices go. And I say that with all the normal caveats of asking prices, by the way. 368k, but the monthly change, the monthly increase has slowed dramatically down to 0.3 of a percentage point from 2.1% in their main numbers. So you can see the annual change has dropped from 10.2 down to 9.7. So that's really important. And it just, if you like, adds to what I'm saying about coming over the peak of inflation and starting to come down the other side. This is available online. I'm not going to take you through every line on here, but it's worth just picking out this headline here, isn't it? It's the 5th price record this year, but further signs of the pace easing. Really important. So we move from asking prices, the hopeful sellers amongst us, into the mortgage approval prices. Here are the Halifax, UK's biggest lender, and you can see that their monthly change is up 1.0%, bringing their annual change to 10.5%. And you can see, look, here it is again. Here's their headline. Every single institution out there, every portal out there, they're doing exactly the same thing. Average house price rises for the 11th consecutive month. But guess what? Overall price slows. We all know it's happening, don't we? We know it's coming. This is easier to see this data when you look at it in chart form like that. So here's the Halifax numbers, and you can see this is the way that they've seen house price inflation across the year. And if you look where we went from February, so this is during the, Rightmove called it the spring frenzy, you remember? And you can see how that has just started to ease off here. This is the annual change. And so even if the 3 month on 3 month numbers are slightly rising, you can see that the monthly number there is leveling out and starting to dip. That's the important bit that we need to look at. And that for me tells us that we are at the top of that rise and we're starting to come down the other side. The Nationwide, unfortunately, these numbers are a bit old because the new numbers come out in 2 or 3 days' time. So these are the main numbers, which were, they're nearly 4 weeks old now. But you can see there that the numbers have dropped from 12.1% in April down to 11.2% in May. It's telling the same story. The 3 month on 3 month, you can see where this is going according to the Nationwide, and my beautifully crafted arrow, which tries to show the trend on the 3 month by 3 month numbers. For me, taking out the COVID dips, that's a really very clear peak and a very clear trend. Into the Zoopla numbers. So the Zoopla numbers are April numbers because, as I say, these are a blend. These are a blend of asking prices, a blend of mortgage approvals, and a blend of achieved prices. I think this is a great index, actually. And you can see there that their current growth for the year is 8.4%. And their demand for homes for the 4 weeks to the 22nd of May is 61% higher than the 5-year average. This is what's doing it. Here is their UK index, and poor old Aberdeen still in negative. But we've got a range there from Nottingham down to Aberdeen, from 10% all the way down to minus 1.7%. I can't believe there's 10 minutes of this presentation gone already. This was going to be the quick trot through the early charts, but it does show you the extraordinary variety in local markets. That's really important. When we come to my plan for working out, my strategy for working out how prices are going to move and at what pace later, we have to bear in mind regional markets, because the difference there is writ large. It's quite interesting, isn't it, when somebody like Knight Frank says, well, we've adjusted our forecast from 5% growth to 8% growth. Yeah, which index? Who knows? The canary slides. So here's the first of the canary slides. Really simple canary slide. It's the UK mortgage approvals. It's quite simple. The mortgage approvals represent about 2/3 of all the sales about 3 months further forward. So it's a really easy and exceptionally reliable way of saying what the volumes are going to look like 3 months on. And you can see how these mortgage approvals then continue to tumble. Interestingly, April was the first time since we've had our post-COVID surge, was the first time that they came in just under literally just under the pre-COVID average, 66,000, which means on our 2/3 principle that if you take that 3 months further forward, you're going to see our July completion sitting at 100,000, which is back to the old pre-COVID levels, isn't it? The 1.2 million a year, averaging out at 100,000 completions a month. So we are definitely coming back to those levels. And we know that because the mortgage approvals are there, and you can't sell more houses than mortgages have been approved for. So we know that that's going to happen. Let's have a little look at the mortgage rate trends, because these are now really important to us. And you can see here, those of you who've watched these MarketCasts before, you'll know that I've split these into these two charts. One is fixed rates over a 2-year period, and the other is fixed rates over a 75% loan to value. And you can see that over the 2-year period, this is starting to get more expensive. And you can see that even our 60% money now is above 2.5%. And when you look at the 75% loan to value chart here, the 10-year money now is really starting to spike. This is going to continue to climb. We know that. So we know that we are going to see interest rates increase. Having said that, interest rates in the past have been exceptionally high. People talk about 1990 and 15%. I actually remember 1979. I don't know how many of you out there are old enough to remember that. The #1 record at the time was by a lady called Lena Martell. This was November 1979. Look it up. And it was actually called One Day at a Time. And quite honestly, when mortgage rates were 17%, interest rates were 17%, you really did live one day at a time. It's no wonder it made #1. Inflation. My preferred measure of inflation when we're looking at the housing market is the CPIH. So that includes owner-occupier housing costs. Important for us because obviously in terms of who is buying or not buying property, most of the people affected by those numbers fall into the category of homeowner. And you can see it sits there just over 7%. It's a 30-year high and it's likely to climb. And probably the most important effect of that on us and our target market is that government will actually take action to try and control it. And that generally tends to mean interest rates will go up. So we will see that happening. Volumes, I'm not going to dwell on because we've spoken just a moment or two ago about mortgage approvals. But here we are, we're starting to level out at 100,000 a month. If you look at the red line here, which is the seasonally adjusted line, take out all the humps and bumps of stamp duty incentives and pandemics sitting in here. And you can see that we're now starting to return somewhere back to where we were pre-COVID, back in this area here. And I think that that's going to settle down through to the end of the year. I still believe that we will end up with 1.3 million transactions this year. That's what I actually put in my forecast that I published in last December. And I still think that's going to be the correct volume. Another canary slide then here. It's the confidence barometer. It's dropped again. I could barely believe that those numbers could fall further than they were the last time I showed you this. But consumer confidence now, the overall index score, this red line, is now minus 41. So for the 2,000 people that GfK talk to each month and ask how they feel things are going to go over the next 12 months, the negative balance, so people saying they thought they were going to get worse rather than better, sits at minus 41. It's the lowest it's ever been since this survey started in 1974. And how about this line here? When you actually look, they ask people how they feel the UK economy is going to fare over the next 12 months. Well, if it gets any lower for this presentation, we'll probably have to ask the people on the 3rd floor in this building if we can use their offices so as I can get you down to where the line's finally got to. The climate for major purchases, that's the green line here. Is it a good time or a bad time to get a new kitchen, to buy a new car, to buy a new house? And you can see how that has taken up a position very, very low. That's historically a low number, but you can see that's pretty much stabilized along there. And this last mauve line here, which is normally, it's the very last line to sort of fall away. And that's where GfK say to the respondents, how do you think your own personal finances, excuse me, how do you think your own personal finances are going to go over the next 12 months? Are they going to get better or worse? And despite everything that's going on, people are invariably optimistic about their own personal finances, yet we dipped just after Christmas into negative, and that dip became a plummet. And that's a technical term. And you can see now, we're right down here. So this is people's own personal financial situation here, again at a record low. So consumer confidence is on the floor. That's going to have a big effect. How big an effect we'll touch on in a minute or two. I'm not going to dwell too much on the RICS numbers this month. I've taken 3 or 4 charts out of this section. Generally, they're very, very similar to where they've been as we're in this sort of mixing layer. I think last month I defined this as a market holding its breath, and certainly that's how the agents feel. I get the sense that a lot of them can't believe that they're still doing these deals and this market is still moving at this pace, and they're all sort of thinking, yeah, any minute now people are going to wake up and things are going to change. Demand dips slightly, although pricing remains firm. That was the RICS headline for this month's survey. And just to give you the canary slides really out of the RICS survey, here they are. These are the newly agreed sales, and isn't that interesting? It looks, doesn't it, like a poor set of teeth really. And you've got some regions there that have said things have got bad in the month to the end of May, and you can see here that some say things have actually got better in the month to the end of May. If you look at the overall UK number right on the end there, you can see it's just down a little bit from where it was in April. I actually don't think that that's anything specifically to worry about. Seasonally, that's exactly what we'd expect. In fact, I'd probably expect a slightly bigger drop. So it's still solid. The sales market is still solid. New vendor instructions. Those of you who've watched previous MarketCast will know this is a real big area of concern for me. We need more stock. One of the biggest issues that are driving this crazy double-digit inflation, unsustainable double-digit inflation, is a lack of stock. And so to have more stock coming on to the market is really important. It's interesting, isn't it, that in Knight Frank's press release that they put out yesterday, changing their forecast, they talked about a lot of sellers coming to the market because they felt that the market was at its peak. So they wanted to sell while it was at its peak. They feel, it's a shame really, because they don't understand the dynamics of how the market works. And we haven't got time to go into that right now. I always think playing the market with your own property is a big mistake. So but you can see here where we are. And if you take those that have got increased number of new vendor instructions and those with decreases, look at the UK average, it comes out pretty much bang on the same. If we look at new buyer inquiries, well, that is significantly down on average across the UK. There are one or two regions here. There's North and West Midlands there that are reporting, and Northern Ireland on the end there, I might add, are reporting increases, but generally across the piece, new buyer inquiries are down. Again, what we'd probably expect coming into May. And have prices gone up or down over the last 3 months? Well, if any of those were negative, we'd have to be worrying about the agent concerned, wouldn't we? Where do the agents feel prices are going? This is where they feel they're going. These are the national price expectations. Now, interestingly, we would expect these to start to come down looking over the 12 months, wouldn't we? What has surprised me is how these have actually started to turn down to the median line here on the dark mauve line, which is over the next 3 months. And that really did surprise me a little bit. In terms of regional price expectations over the next 3 months, you can see, well, it's a gloomy outlook in the East and West Midlands, but aside from that, everybody feels fairly positive that we'll still have inflation over the next 3 months. Quick look then through the Rightmove June numbers, their indices here. Here's this flattening line on the average asking price trend. You can just about see that flattening line on the top of the 5-year trend. This is though really important here. Here's the percentage monthly changing asking prices from 2.1. We've been here in the spring frenzy, and we're now come to here. Whether that is a blip, well, next month will tell us. And it seems that the average time to find a buyer now has actually settled still at a very, very low 32 days. But you can pick these details up. In terms of stock, really important, stabilizing and starting to climb. That can only be good news. These are some of the charts in the Zoopla Advantage deck for this month, which I thought were really, really interesting. Well worth a look if you get a moment. This is Zoopla's index of asking price reductions. And you can see here that if you look at the UK overall, this 5% of property listings where the price reductions were made, this was the year to May 2021. The month to the end of April showed that at 4.7%. But look how that's increased over the last month. And we are now, for May 2022, that number is just slightly higher than it was last year. Really interesting if you get a chance to go have a dig into that. And I think that gives a great indication. Start to think about consumer behavior now. So you've got people coming to the market because they feel it's at its peak. You've got people starting to reduce crazy asking prices because they recognize it's probably peaked. We all know where we are in this market, don't we? And here's the time to sell. And you can see there that these are the April 2022 numbers compared to the March 2022 numbers. And you can see that there is a slight, London aside, you can see there's a slight uptick in the time that it's taken to sell as well. Okay, I think the Zoopla price index is a really good one. I think their combination, they've got that blend just right. And you can see where that is moving. Okay, I need to keep an eye on my time because this is a really interesting part. It's been great to sort of set this up by taking you through those charts and through that data. But I would be surprised if I have told you anything so far that you didn't already know. And if you've tuned in this morning after one of my emails or whatever, this is probably what you're going to want to know about, isn't it? So I am going to introduce you now to my market factor matrix. Oh, wait, hang on. TM. It had to have a sexy name, didn't it? Because it's an extraordinary thing. When you talk to clients and talk to people, and everybody obviously is thinking about tactics and mid and long-term strategy. And when you're looking at land and you're looking at doing deals now that won't come to fruition for 2 or 3 years, How the market's going to move over that period really becomes very, very important indeed. So how do you calculate that out when there are so many factors involved? So I sat down and just started to list all of the things that either had a positive effect on the market or a negative effect on the market, which should then start to give us some idea of quantum of price shift and volume shift. Then you look at the things that actually have a high impact, and then the things that have a slower, lower impact. So here we've got an idea of quantum movement in price and volume, and here we've got an idea of the time scale over which that is actually going to go. So let's just try and populate. I tried to populate this. So if we take something like that we've been talking about all the way through this presentation, low supply, high demand, that's actually high impact, isn't it? If you can't get something, you obviously want to go after it much more quickly, and it is going to have a very positive effect. That's high on the right. Low fixed mortgage rates. Again, that's actually going to have a fairly high impact effect, and it's going to have a positive effect. The hot employment market, that's more of an underlying thing, so it's a lower impact of lower speed. The lifestyle changes that we all talked about that came after COVID, the working from home, the more space required. So that's actually going to have a positive effect too, but that's a much slower, more structural effect on the market. So they're the sort of positive effects. What about the negative effects? We've talked about low consumer confidence. I talk about that pretty much every month for the past 6 months as confidence has fallen away. So that sort of sits in the middle. Rising mortgage rates. That actually starts to have a more negative effect and a higher impact. Low affordability. Once people can't afford to buy, well, then that really starts to move you here. And then we start to look at the sort of more underlying things that have a lower speed impact, but a very negative effect. General inflation sits here. Running costs, homeowner running costs, energy costs, fuel costs, and so on. So these are things over which we have little control in the business. But here's where it gets exciting, because obviously for those of you out there watching this that are in the new homes industry, well, you have all sorts of things you can do to influence this chart here. Let's stick a couple of enablers in. Here's part exchange, and here's discounts for those of you that have perhaps pushed those prices a little bit too far, too fast. Then of course, there's another big player in all this, and that's the government. Help to Buy goes. We all know 2023, we're pretty much done with it. The deals now for Help to Buy 2023, we're on the very last knockings of those now. Will there be a replacement? Well, who knows? Tax incentives, like the stamp duty, land tax, but there's all sorts of other tax incentives the government could introduce that could have a positive effect if they seek to underpin this market. But then if they really start to worry about inflation and where it's going, they have the atom bomb down here, don't they? And this is what I've got in my right bottom right-hand corner, high impact, very negative effect. And that's the non-availability of mortgage finance. So here are all these things that sit on this matrix that will affect the way that prices move and the speed in which they move and affect the volume of properties sold. So this is really, really important. Let's maybe take a look at what I think where today sits. So I've taken those political things out because, as we know, the stamp duty land tax is back to where it was. Help to Buy is pretty much gone. We're on the last knockings of it. And as things stand, there is no control over the availability of mortgage funds. And certainly the institutions are much better funded and capitalised than they were in the 2008-9 recession. This is where we sit, and on the basis of that matrix and all the research that we have and all the data that we have on buyer behaviour according to these factors that affect their buying decision and their buying journey, well, I calculate that as meaning this. I reckon that we are going to see the month-on-month increase stalling by the end of September at the latest. I think we're going to see negative monthly growth in November, from November till the end of the year. So we're still going to see an annual inflation number that's not going to help you on a month-by-month basis. We are going to see those prices falling. So that means that the average prices that you're seeing now on asking prices on Rightmove and the prices on Halifax and Nationwide, Zoopla and so on will be about where they are now when we get to the end of December, which of course, bearing in mind we're in an inflation spiral at the moment, that will feel like deflation. There'll be further corrections in the new year, and obviously that will be affected by government decisions and policy. There you go. That's my take. It's now a matter of record. Before I do my final Be More Roadrunner Wile E. Coyote, let me just remind you that our next market cast will be a really important one, and we'll be able to see whether this is actually coming right. And that's on Thursday, July the 28th. So pretty much a month from today, and at 8:30 a.m. Again, finally, 2 minutes. I know I'm running over just a tad. I wrote a piece in House Builder about 3 or 4 months ago about being more Roadrunner. I would love to have stuck a picture of the Roadrunner and Wile E. Coyote here falling off the end of a cliff, but then it goes out on YouTube, and if somebody from Warner is watching, well, then the lawsuit would arrive the following day. So you'll just have to make do with the words but. I used to do this on a regular basis. I used to love doing this. I used to call it the Halifax Index Challenge. And if I was speaking to groups of people in the industry, I'd hand them all pieces of paper with the 1984 Halifax Index number on it and we adjusted up-to-date number here. This one is 2016. I just grabbed this out of my computer, out of my laptop. And so here's where we were back in 1984. And here's where we are pretty much today. Okay, everybody, join the dots. And it was fascinating to see how they would do that. And the one thing that you would find for people that have been in the business for a long time is they'd go screaming up here through the 80s, and they would crash down through into negative for 1990. And then afterwards, I'd give them the actual Halifax numbers. So these aren't my numbers, these are Halifax's numbers. And they look like that. And people would come up to me afterwards and say, what are you talking about? I was actually working in the business in 1990. It was a fall in values of 30%. I mean, what you're saying is absolutely ridiculous. And I call this the Wile E. Coyote syndrome. This is that bit where you are running up that huge hill, that high escarpment, and you're running along so fast and it's rising so high that you're taking no notice of anything else. And you haven't realised that the ground has suddenly disappeared from underneath you, and you carry on running for about another 500 yards, and then you look down and there's nothing there. And as you plummet to earth, you realise then that you took your eye off the ball just for a moment or two. Here's my explanation for the 1980s and why everybody thought that I'd got that so hopelessly wrong. Here we go. Here's the climb in inflation, up from the mid-80s to the late 80s. This is a time when we used to actually have to keep our site launches secret. Otherwise, queues used to start forming outside sales offices. It was a great time to be in advertising. Don't tell anybody we're launching a site. And you can see it was climbing like that till we got to 1990. Massive interest rate hikes, huge government action to stop inflation. And suddenly inflation went from 24% per annum, 24% to zero. Well, of course, everyone in the industry had been planning their sites on that 24%. In their eyes, this is what was happening here. This was their perceived inflation. This was the coyote running up the hill, where actually what had happened is the ground had disappeared and was coming along here. This was the actual inflation. Halifax, their own numbers. So when suddenly you look down and the ground isn't there anymore, it feels like a 30% fall in value. Now, I'm not saying we're going to have the same fall away in value that we had in 1990 over the next 2 years. I think that the conditions and the underlying conditions are so completely different. However, let's just all keep a little look down to the ground, and let's just all consider how prices are moving, particularly in local and regional markets, before we set the prices on the next round of increases for our developments out there. Obviously this doesn't touch on local markets. There's just not enough time. But for any of our clients out there that want me to come and talk about micro and local markets, obviously I'll be happy to do that. Hope you've enjoyed it. It's a 3-minute overrun again. I will get better at doing that, but that's about it for MarketCast 4. Big thanks to Joan, big thanks to James, who've helped put this presentation together this morning, and I will see you at the end of July for MarketCast 5.